Breaking news alert, and you need to hear every word of this. It is February 21st, 2026, and the financial world woke up this morning still processing the single most consequential legal ruling on American economic policy in decades. Yesterday, Friday, February 20th, 2026, the United States Supreme Court delivered a historic 6-3 decision that struck down President Donald Trump's sweeping tariff agenda, the very tariffs that had reshaped global trade, rattled markets, and sent gold on one of its most explosive bull runs in modern history. And now, with the tariffs gone, at least the IEEPA-based ones, gold is doing something surprising, something nuanced, something that every investor watching this channel absolutely needs to understand right now. Gold is not collapsing. Gold is not celebrating. Gold is doing what it always does when the world gets complicated. It is holding its ground. Welcome back to the channel. If you are new here, this is where we break down the big financial stories in plain language, because the decisions happening in Washington, in courtrooms, and in central banks are directly affecting your wealth, your savings, and your financial future. Today we are going deep on gold, on the tariffs ruling, on the U.S. economy, and on what the smart money is actually doing right now. Before we go any further, if this kind of content adds value to your financial education, please take 5 seconds right now and hit that like button, subscribe to this channel, and smash that bell icon so you never miss a major financial news update. We post regularly and we go beyond the headlines. Every subscribe, every like, every comment helps this channel grow and helps more people get access to real financial news. Now let's get into it. The Supreme Court's ruling came down on February 20th, 2026. The vote was 6-3, with Chief Justice John Roberts writing the majority opinion. Joining him were Justices Sotomayor, Kagan, Gorsuch, Barrett, and Jackson, a cross-ideological coalition that sent an unmistakable message to the executive branch. Justices Thomas, Alito, and Kavanaugh dissented. The ruling centered on one fundamental legal question: does the International Emergency Economic Powers Act, known as IEEPA, grant the President the authority to unilaterally impose tariffs of unlimited scope and duration? The court's answer was a definitive no. Chief Justice Roberts wrote in the majority opinion that the Constitution assigns the power to lay and collect taxes and duties directly to Congress, not the President. He emphasized that in IEEPA's entire half-century of existence, no prior president had ever invoked the statute to impose any tariffs, let alone tariffs of this magnitude and scope. The court applied what is known as the Major Questions Doctrine, the same legal principle used to block President Biden's student loan forgiveness program, which holds that when a president seeks to take actions with vast economic and political consequences, he must be able to point to clear congressional authorization. In the court's view, President Trump could not. The tariffs in question were the so-called Liberation Day tariffs, the sweeping reciprocal levies Trump announced on April 2, 2025, targeting nearly every U.S. trading partner, with rates ranging from 10% to as high as 50%. Trump had justified them by declaring the U.S. trade deficit a national emergency, citing IEEPA as the legal mechanism. What followed was a cascade of lawsuits from small businesses, a dozen Democratic-leaning states, and pro-business groups across the political spectrum. The U.S. Court of International Trade ruled the tariffs illegal in May 2025. The U.S. Court of Appeals affirmed that ruling in August 2025. The Supreme Court then took the case on an expedited basis and heard oral arguments in November 2025. And now 3 months later, the highest court in the land has spoken. Trump's response was immediate and furious. He called the ruling deeply disappointing and said he was ashamed of certain members of the court. He vowed to reimpose tariffs through other legal mechanisms, including Section 122 of the Trade Act and the existing Section 232 and Section 301 authorities that were not affected by the ruling. Trump signed an order on Friday imposing a 10% global tariff under Section 122, while steel, aluminum, and auto tariffs imposed under Section 232 remain in place. The message from Trump was clear: this fight is not over. Other alternatives will now be used, he said. We have great alternatives. Now let's talk about the financial impact, because this is where it gets fascinating for anyone watching the gold market. When the ruling dropped shortly after the New York market opened on Friday morning, the initial reaction was exactly what most analysts expected. Stocks moved higher. The S&P 500 spiked as much as 1%, before settling around 0.3 to 0.5% higher on the day. Consumer discretionary, industrials, technology, and real estate sectors led the gains. Companies directly exposed to tariff risk, furniture retailers, logistics firms, appliance makers, surged. Wayfair rose more than 5%. Amazon and Apple were among the best performing Dow stocks of the day. Bond yields rose, with the 10-year Treasury hitting 4.09%. The US dollar weakened. Gold, however, did something more nuanced. Spot gold initially pulled back, slipping off its highs after the ruling was announced, as reduced trade war risk theoretically lowers the urgency for safe haven positioning. But here's the critical point that every investor needs to hear. Gold did not collapse. Gold held. And by the end of the session, spot gold remained higher on the day, trading around $5,070 per ounce. Silver gained 3.4% to 81.2 an ounce. Platinum rose 2.8% to $2,127 per ounce. Why? Because the Supreme Court ruling removed one risk from the table but left a dozen others firmly in place. Let's start with the U.S. economy itself, because the gold market was already receiving deeply troubling signals before the tariff ruling even dropped. On the same morning the Supreme Court announced its decision, the Bureau of Economic Analysis released its fourth quarter 2025 GDP data. The number was sobering. The U.S. economy grew at just 1.4% in the final quarter of 2025. That is not a recession, but it is dangerously close to stall speed, particularly when you factor in a core PCE inflation reading that came in at 3%, still well above the Federal Reserve's 2% target. This is the toxic combination that economists fear most: slowing growth paired with persistent inflation, stagflation. A situation where the Federal Reserve cannot easily cut rates to stimulate growth because inflation remains elevated, and cannot raise rates to fight inflation because the economy is already fragile. The odds of a Federal Reserve rate cut in June dropped from 50.2% to 46.8% following the GDP and inflation data. That is a market saying it is no longer confident the Fed can ride to the rescue. And when the Fed cannot cut rates, the opportunity cost of holding gold, which pays no yield, actually becomes more manageable in relative terms, especially when investors are worried about economic deterioration. In this environment, gold's safe haven appeal remains entirely intact. Then there is the geopolitical dimension. Even as one source of uncertainty, Trump's IEEPA tariffs, was removed by the Supreme Court, the global geopolitical landscape remains highly charged. U.S.-Iran tensions have continued to simmer throughout February 2026, with Washington warning U.S.-flagged vessels to stay away from Iranian waters and military options being discussed at the highest levels. Middle East risk has historically been one of the most reliable drivers of safe haven demand for gold, and that risk has not gone away. Add to this the question of what Trump does next on trade policy. The Supreme Court ruling does not prohibit tariffs. It simply says they cannot be imposed through IEEPA without congressional authorization. The Section 232 tariffs on steel, aluminum, autos, and heavy trucks remain fully in place. Trump has already signaled he will use Section 122 of the Trade Act to impose a blanket 10% global tariff. The Tax Foundation has noted that while the IEEPA tariffs, if fully dismantled, would eliminate roughly $1.4 trillion in projected 10-year revenue, the remaining Section 232 tariffs alone would still generate an estimated $635 billion over the same period, amounting to an average tax increase of around $400 per U.S. household in 2026. The Penn Wharton budget model estimates that through February 20th, IEEPA tariffs alone had generated approximately $160 to $165 billion in revenue. The question of refunds is now center stage. The ruling has been remanded to the U.S. Court of International Trade to address the refund issue. Justice Kavanaugh, in his dissent, warned the refund process would be a mess. Capital Economics estimates that if full refunds are ordered, the cost could reach approximately $120 billion, roughly 0.5% of U.S. GDP. Evercore has called the process a legal and bureaucratic morass. This level of uncertainty is not something financial markets or gold investors can simply ignore. And here is something else that gold analysts are watching very carefully: the behavior of central banks. In 2025, global gold demand rose to a record 5,002 tons. Central bank purchases hit 863 tons for the year. China's central bank has now extended its gold purchases for 15 consecutive months through January 2026. This is not a trend that gets reversed because a Supreme Court ruling removed some tariffs. Central banks around the world, particularly in emerging markets, have been deliberately diversifying away from US dollar assets. The de-dollarization trend is structural, not cyclical. It does not turn off because of a single legal ruling. Goldman Sachs, one of the most closely watched voices on commodities, has said that any recent slowdown in central bank gold buying is temporary, and the firm expects gold to climb toward $5,400 per ounce by the end of 2026. J.P. Morgan Global Research forecasts gold to average $5,055 per ounce in the final quarter of 2026, rising toward $5,400 by the end of 2027. Deutsche Bank has reiterated its $6,000 per ounce year-end target. Societe Generale has also moved to a $6,000 target, calling it potentially conservative. For context, gold hit an all-time high of $5,595 per ounce on January 29, 2026, and is currently trading around $5,070 to $5,107 per ounce as of February 21, 2026. The Yale Budget Lab has estimated that the Supreme Court ruling could drop the average effective U.S. tariff rate from approximately 17% to around 9%, a meaningful reduction that could ease some price pressures for American consumers over time. That is genuinely good news for inflation. But the question is whether that relief comes fast enough, and whether it is offset by the new tariffs Trump is already putting in place through other legal channels. Investors are clearly not treating the Supreme Court ruling as a green light to abandon safe haven positioning. The gold market's behavior on Friday told the real story. Gold pulled back initially as risk-on sentiment briefly took hold, but quickly recovered. Silver, platinum, and palladium all rallied. The precious metals complex held up in the face of what should have been a strong headwind. That behavior reflects something important. The market understands that the structural drivers supporting gold are not dependent on any single policy, any single court ruling, or any single administration. What are those structural drivers? Let me walk through them clearly. First, the U.S. national debt has grown to levels that many serious economists, including Ray Dalio, describe as genuinely alarming. The debt burden combined with elevated interest costs is creating a fiscal feedback loop that weighs on the long-term credibility of the dollar. Moody's downgraded the U.S. credit rating last year, eliminating the country's final pristine credit score from any of the three major agencies. That is not a small thing. Second, real interest rates, the rate of return on bonds after adjusting for inflation, remain at levels that do not offer a compelling alternative to gold for investors concerned about purchasing power preservation. Core PCE at 3% with rates potentially on hold means the real yield environment continues to support gold. Third, ETF demand for gold surged by 801 tons in 2025, the second largest annual inflow on record. Institutional and retail investors around the world are actively building gold positions, not just speculating in the near term. Fourth, geopolitical risk, from U.S.-Iran tensions to unresolved conflicts in Eastern Europe to the broader fracturing of the post-World War II international trading order, keeps a floor under safe haven demand that is very difficult to remove. Fifth, and perhaps most significantly for the long run, the very nature of this week's Supreme Court ruling introduces a new layer of policy uncertainty. Trump has vowed to fight back through every available legal avenue. He is already implementing new tariffs under different authorities. The trade relationship between the United States and the rest of the world is now entering a new phase of legal, political, and institutional contestation. That kind of uncertainty, the kind where the rules themselves are being rewritten in real time, is precisely the environment where gold historically outperforms. For investors, the takeaway is not that gold is about to surge past $6,000 an ounce tomorrow. The takeaway is that the fundamental case for owning gold, as a hedge against currency debasement, economic uncertainty, geopolitical risk, and institutional instability, has not been weakened by the Supreme Court's ruling. If anything, the post-ruling environment, with its refund chaos, new tariff uncertainty, weak GDP, sticky inflation, and ongoing geopolitical tensions, reinforces that case. The question for every investor watching this video is not whether gold belongs in a diversified portfolio right now. Most serious institutional analysts say it does. The question is how much exposure is right for your specific situation, your timeline, your risk tolerance, and your existing portfolio composition, that is a personal financial decision that should always be made in consultation with a qualified financial advisor. And we are not providing personal investment advice on this channel. What we are doing is giving you the information and the context you need to ask the right questions and make informed decisions. What we know right now, as of February 21st, 2026, is this. Gold is trading at approximately $5,107 per ounce. It hit an all-time high of $5,595 on January 29th. It pulled back, corrected, and is now consolidating around the $5,050 to $550 range. The Supreme Court struck down IEEPA tariffs in a historic 6-3 ruling. Trump is reimposing tariffs through other mechanisms. U.S. GDP grew at just 1.4% in Q4 2025. Core inflation remains at 3%. Central banks are still buying gold aggressively. Goldman, J.P. Morgan, Deutsche Bank, and Societe Generale all have bullish year-end gold targets ranging from $5,400 to $6,000 per ounce. And the structural drivers of gold demand, de-dollarization, fiscal stress, geopolitical risk, and investor demand for a genuine safe haven are firmly intact. The Supreme Court may have slowed Trump's tariff machine, but it has not changed the world that gold investors are navigating. That world is one of elevated uncertainty, shifting institutional trust, slowing economic momentum, and a global reallocation of reserves away from the US dollar and toward hard assets. Gold is not just a commodity, it is a signal. And right now, the signal is clear. Stay informed, stay diversified, do your own research, always consult a financial professional before making investment decisions, and we will see you in the next video.